Welcome to the Deep Dive. Today we're jumping straight into what was, I think, the most watched earnings call of the day. Oracle's Q2 Fiscal 26 results, which dropped right after the bell on December 10th.
And this was when everyone had circled on their calendar. This quarter was supposed to be the pivot point, the moment where all those huge AI contract wins, all that hype, finally started hitting the bottom line in a real way.
That's it, exactly. And that sets up the core tension we really need to unpack for you. Oracle served up this spectacular promise, this massive long-term backlog.
A record backlog.
A record, yeah. But that promise was completely overshadowed by the, let's call it the brutal reality of the short-term cash they need to actually deliver on it. The market's reaction was not warm.
Not at all. The post-call tone was incredibly cautious. And if you just look at the top-line numbers, you see this split personality, this dual narrative right away. On profitability, they looked great.
A solid beat, right?
A huge beat. Non-GAAP EPS came in at $2.26. The street was looking for something like, what, 164? So a massive beat.
Okay, but you have to peel back the onion on that one. That headline number looks amazing.
Yeah.
But it was heavily boosted by one thing, wasn't it?
One single thing. A $2.7 billion pre-tax gain from selling their stake in the chip company Ampere. Without that, the picture is very different.
Right. And then you look at revenue.
And it gets a bit murkier. Total revenue was $16.1 billion. Now, that's still 14% growth year over year, which is solid.
Sure.
But it was a slight miss. The street wanted to see 16.2. And cloud revenue, so IS plus SaaS, that hit $8 billion, up 34%.
And let's focus on that IS number for a second, the infrastructure as a service piece. That's the real barometer for AI, right?
It is. And it grew 68% year over year, which, don't get me wrong, is incredibly strong growth. It's $4.1 billion. But the most bullish analysts were hoping for something in the mid-70s.
So, little soft.
Yeah.
It kind of gives you the first clue, right? Signing the AI contracts is happening at a blistering pace, but actually deploying the hardware and turning that into revenue. That's taking a bit longer than people hoped.
And that brings us to the number, the one number that explains both the massive potential and the massive risk here, the RPO, remaining performance obligations.
Which is basically their backlog. It's contracted future revenue. It's the promise.
It's the promise, written in ink. And Oracle's RPO surged to an absolutely eye-watering $523 billion.
$523 billion. That's up 438% from last year and up $68 billion in just this one quarter.
Yeah, it's driven by these colossal commitments from, OpenAI, Meta, Nvidia. That number right there, that's the entire long-term bull case for the stock.
Okay, let's unpack this because
I agree.
That RPO is phenomenal. It justifies the bull case. But the market, which, just hammered the stock down 10, 11% after hours, it wasn't trading on the RPO. It was trading on the balance sheet, on the cash flow.
Exactly. The question became, how do you pay for all this?
Right. And how long does it take? Because that RPO might be non-cancelable. But what if there are delays?
Right.
What if that revenue timeline stretches out even further?
That is the trillion-dollar question. Or, the $500 billion question. And it leads us directly to the Capex shock. This was the number that really scared people.
Yeah.
Q2 capital spending was $12 billion. The expectation was 8.4. So it just blew past estimates.
And they didn't stop there. They raised the full-year Capex plan for fiscal 26 by another $15 billion. So now they're projecting $50 billion for the whole year.
$50 billion!
Let's just put that in context for everyone. $50 billion is getting close to what AWS and Microsoft Azure spent combined in fiscal 25. Oracle is spending like a company trying to play catch-up in a single year.
And that spending, that fire hose of cash going out the door, it immediately fed into concerns about their debt. They're already sitting on about $100 billion in long-term debt.
So you started to see the credit markets get nervous.
Instantly. The credit default swap spreads, the CDS spreads, they started widening. Which is just the market's way of saying it now costs more to insure Oracle's debt against a default. It's the credit market waving a big yellow flag.
So management had to spend a lot of time on the call addressing this, right? How are you going to pay for this without wrecking your credit rating?
They did. They were very clear that they're committed to keeping their investment grade rating. That's crucial. And they outlined some pretty clever ways they're trying to minimize the cash burn up front.
Like the leases.
Like the leases, yeah. They're leasing land, buildings, power. They don't pay until the data center is actually delivered and operational. It minimizes the cash drag while things are being built.
And what about this idea that customers are bringing their own chips? That was mentioned for some of these huge deals. Is Oracle just becoming the landlord here? The utility company providing power and cooling?
I mean, that's a perfect way to put it. It's a very creative way to get the single biggest cost component, the GPUs, off your own balance sheet. They also talked about suppliers leasing them chips instead of selling them outright.
So it's all about timing.
It's all about trying to sync up the cash going out with the revenue coming in to borrow as little as possible.
Which brings us to the show me challenge. Margins. Free cash flow. What's the payoff for this $50 billion spend?
Right. Management kept saying that these AI workloads over the life of the contract have a really healthy 30 to 40% gross margin, which sounds fantastic.
Right.
But in the here and now, during this insane build-out phase where they're delivering capacity like crazy, I think it was 400 megawatts this quarter alone, the costs are just spiking. And that's why free cash flow was negative $10 billion in Q2.
Negative 10 billion. Wow. So the whole story is a timeline.
Yeah.
When does that capacity turn into profitable revenue?
That's the key variable. The other big risk they had to address was concentration. You have a few mega customers driving this massive backlog. What happens if one of them stumbles?
And their answer to that was fungibility.
Fungibility. They said it over and over. This AI infrastructure they're building, it's the same cloud they deliver to everybody. So if one customer has an issue, they can reallocate that capacity to another customer in, they claim, a matter of hours.
So the hardware isn't stranded.
Exactly. It mitigates that concentration risk. They can repurpose it pretty quickly to meet demand from their hundreds of other AI customers.
So let's shift from the financials. How does this $50 billion spend actually change their strategic position against, say, AWS or Azure?
Well, that brings us to the Ampere sale. That wasn't just a financial move to book a gain. It was a huge strategic pivot.
It was an admission of defeat, in a way.
It kind of was. Ampere was their attempts to build their own custom silicon, like Amazon's Graviton chips. Selling it is basically them saying, okay, we can't compete with Nvidia and AMD on chip design, so let's stop trying to be a producer and focus on being the best distributor.
So they become chip neutral. They can offer whatever the customer wants. Nvidia's latest, AMD's MI355. It's all about flexibility.
Right. But you brought up a great point earlier. Doesn't that expose them to supply chain risk? What if Nvidia decides to prioritize Microsoft or Google?
It's a huge risk, a dependency.
It is. But Oracle is betting that their scale, and more importantly, their unique position as the only true multi-cloud provider, gives them leverage. And that multi-cloud database strategy is their killer differentiator.
It really is unprecedented. They're building data centers inside their rivals' facilities. AWS, Azure, Google. It's like, you said it before, McDonald's opening a counter inside a Burger King.
And it is working. Customers are clearly tired of being locked into one platform. Their multi-cloud database consumption was up 817% year over year.
800%. That's not just growth. That's a land grab.
It's a customer rebellion. And they're leaning into it with things like multi-cloud universal credits, so you can commit to Oracle once and then use your database services on any cloud you want.
So here's where it gets really interesting for me. The AI data platform.
Oh.
This is Larry Ellison's big vision.
This is the whole pitch. It's not just about selling raw compute. It's about building this AI database that can unify and vectorize all of a company's data.
And not just Oracle data. That's the key.
That's the unlock. They're talking about pulling in data from MongoDB, from Snowflake, from custom apps, everything. They catalog it, vectorize it, and then let the big LLMs, ChatGPT, GRO, Gemini run on top of it securely.
So you can ask a question and get an answer based on all your private enterprise data, not just what's in one silo. That is a very compelling pitch.
It is, and you can see it feeding back into their applications business already. Fusion ERP was up 18%, NetSuite up 13%. And critically, deferred revenue for apps grew faster than current revenue. That's a strong indicator of future acceleration.
And they're pushing the cross-sell with the One Oracle sales reorganization.
Right. No more buying apps from one team and infrastructure from another. It's all about making sure every application sale pulls through a big chunk of that high-margin AI infrastructure revenue.
We're seeing real products, too. The clinical AI agent in healthcare is now live with hundreds of customers. They got regulatory approval for a new AI-based EHR, so this isn't just a slide deck.
It's happening. But let's connect it all back to the guidance, because this timing issue is still the ghost at the feast here.
Okay, so what do they guide for next quarter, Q3?
The guidance was actually pretty good. Total revenue growth of 19 to 21%, total cloud growth of 40 to 44%, and EPS of about 170 to 174, which is above the street.
That all sounds fine. So what's the problem?
The problem is the long ramp. They stuck to their full-year revenue number of $67 billion, but the real payoff for this $50 billion spend is still a ways off. They specifically called out about $4 billion of incremental annual revenue in FY27.
So 2 years from now.
2 years from now. So for you, the listener, what does this all mean? You have a company spending $50 billion this year, and they're telling you the biggest payoff for that spend is still that far down the road. The entire story now is execution.
Can they keep growing I&A at 60+%? And can they convert that massive RPO into cash before the debt and the Capex spend start to really worry the credit rating agencies?
That's the whole ballgame.
This clash, this tension between the short-term pain and the long-term promise is exactly the kind of setup that options traders love. So before we wrap, let's dive into our This Is Not Financial Advice segment and pitch an outrageous but plausible trade.
Yeah, this setup is perfect for an options play. It's built for it. We'll call this trade the short-term pain, long-term call. The thesis is simple. The market has already punished the stock for the Capex. That 10% drop, the wider CDS spreads, that's all priced in now.
Okay, so the immediate bad news is known. The risk is really about the timing of the RPO conversion. So what's the action?
Well, options were pricing in about a 10% move, and we just got that to the downside. So the volatility is high right now. The trade is to use that high volatility. You sell near-dated put spreads, let's say for the Q3 expiry betting that the worst of the stock's collapse is over for now.
And you use the cash, the premium you collect from selling those puts.
Exactly. You use that premium to finance buying long-dated call options. I'm talking way out, like 2028 expiry, deep in the money.
So you're basically using the market's current panic to fund a multi-year bet that they eventually pull this off. You're betting they can survive the short-term credit scrutiny and actually deliver on that RPO.
That's the trade. You capture the potential windfall if that $4 billion revenue ramp in FY27 is just the beginning, and you're using the premium from the known high near-term volatility to pay for it. The outrageous part is betting on 2028. The plausible part is leveraging the no numbers, the high volatility, and that record-breaking RPO.
It is a classic high-risk, high-reward proposition. So to sum it all up, Oracle is at this huge inflection point. The AI ambition is staggering with a $523 billion order book, but the financial strain to achieve it is just as staggering with a $50 billion cash burn.
And here's a final thought for you to chew on. Despite that massive backlog, the market is laser-focused on one thing, and it's the cash burn. If their ability to maintain that investment-grade debt rating starts to look shaky, does any of the AI opportunity even matter? Or does credit risk just become the entire story?
That is the multi-billion-dollar question, and the only answer will be execution. For you watching this story, you need to keep a close eye on their IRS growth rate and any changes to that massive Capex plan. Those are your key signals going forward. That's all for this deep dive. We hope you feel well informed.